Coming up, Apple's Tim Cook steps down, inflation expectations rise, and the market's on hold. Details next. Hi everyone, welcome to the SBS On The Money podcast for this Tuesday, the 21st of April 2026. It's a day where the Australian share market pretty much finished where it started. We'll have the details with Michael Wayne from Medallion Financial Group. If you're new to the podcast, welcome. We go into more detail of the top consumer finance and market news stories covered during On The Money on SBS World News. But first, Tim Cook is stepping down as the CEO of Apple. After 15 years in charge at the tech company, he launched products like the Apple Watch, AirPod in that time, along with some streaming services and payment technologies. Under his tenure, Apple's share price skyrocketed nearly 2,000%, outperforming the Nasdaq, which tracks the top 100 tech companies in the US, and the broader S&P 500. Its future, though, may be tied to how the company manages artificial intelligence, which will be a job for incoming CEO John Ternus, a 25-year veteran at Apple and currently Senior Vice President of Hardware Engineering. So for more about where to next for the company and his take on Tim Cook's leadership, Stephanie Youssef spoke with Dan Ives, the Global Head of Tech Research at Wedbush Securities in the US.
So Dan, what legacy does Tim Cook leave behind?
Well, Tim Cook's a Hall of Fame CEO. I mean, we're talking Mount Rushmore of CEOs, not just in tech, but I'd say in corporate America over the last 50 years. And he took over for Steve Jobs. And I think Apple would not be where it is today if it's not for Tim Cook. These are going to be huge shoes to fill, in terms of going forward, just given the legacy he's created.
So why now? Does the timing surprise you?
Look, I think the timing's a surprise. To some extent, the AI strategy's been in flux, and clearly he's handing the baton at a time that he feels comfortable that, this ultimately will be a successful time for Apple. But look, for Cook leaving at this point, I think it's definitely a surprise from a timing perspective. It's a bit of a shock to the system for investors. And I think it's something that investors have to digest. And even though you have a company veteran taking over as CEO, you don't replace Tim Cook.
So he's being replaced by John Ternus. What do we know about him? How is he likely to lead the company? And what does the future of Apple under his leadership look like?
Yeah, Ternus is a hardware veteran, been at Apple almost 25 years. A key part of all the hardware innovations, from iPhone to everything that they've come out with, from AirPods to everything else. But look, it all comes down to the AI strategy. And even though this is doubling down on the hardware, it really is in Ternus's hands to be successful on AI. That will be his legacy. And I think Cook's leaving it at a good time, but that's the opportunity and the challenge going forward to make sure Apple is not on the outside looking in when it comes to AI.
So how will investors view this?
Look, I think investors are going to view it mixed because there's a Cook premium. I mean, when Cook's flying the plane, you feel pretty comfortable sitting in 2A watching Netflix. And that's going to be a challenge taking over. Now, on the other hand, investors would feel that the fact that he's leaving it at this point feels very comfortable about earnings, feels very comfortable about the AI strategy, specifically at the next developer conference, WWDC, and maybe change could be good. So I think that mixture, investors will kind of have a wait and see approach.
That's Stephanie Youssef there speaking with Dan Ives, the Global Head of Tech Research at Wedbush Securities in the US. Let's go to the Australian share market now. And for a third session in a row, the ASX 200 barely moved, down just 0.04% or 3.9 points as investors wait for Donald Trump's Thursday morning ceasefire deadline. Consumer staples did best today, while tech stocks also rose. Macquarie Group hit a 52-week high and energy fell. For more, I spoke with Michael Wayne. He's the Managing Director at Medallion Financial Group. So, Michael, after quite a bit of volatility on the local market, shares have been relatively unmoved both yesterday and today. Are investors taking a bit of a breather, or is this the calm before the storm?
It's difficult to say. I mean, the calm before the storm comment is somewhat um, something that has played out in recent years. We sort of see just before really the COVID selling started to come into full force, markets were very calm. Likewise with tariffs this time last year, there was a lot of talk about tariffs. The markets were initially willing to brush it off, only for things to fall away very quickly. So that is certainly potential. We're reaching the Wednesday deadline for the truce. So if the negotiations don't reach an outcome, things would certainly ramp up pretty quickly and markets could be off very quickly, similar to what we saw a few weeks ago with falls in the magnitude of 5 to 10% over a few days.
What do you make of the way investors here and overseas have reacted to the war in general terms? Because there's a lot of uncertainty out there. Wednesday is a big point there. Yet shares in the US are at records. Korea today hit a record high. And, the Australian share market isn't that far off either.
Look, understandably, markets are very anxious with where things are at, but at the same time, they are reacting rationally when presented with the historical context. And history suggests that these disruptions prove to be fairly temporary. You only have to cast your mind back to 2022 when the Russia-Ukraine conflict emerged. There was a very similar reaction in the oil price. Markets reacted in a similar manner, but as the weeks passed, the markets seem to become a lot more comfortable with where things are at. And we're seeing the same thing really play out this time around. So as long as the oil price remains fairly stable and doesn't start to take off higher again, I think the markets are pretty confident that this will pass at some point. They're of the view, I think, at this point in time that Trump has the midterm elections to worry about later in the year. So the sense is that we're going to reach the end destination regardless of how we get there, kind of thing at the moment. So yeah, the markets are certainly very, very confident that a resolution will come to be. And that has proven to be the reality. If you look at the conflicts going back to the 70s, you get this initial run up in the oil price, things start to moderate, and then markets can focus on the long term. So as long as this isn't a permanent supply shock, I think the markets will continue to look through it.
Even if we do get an imminent resolution, there's still going to be an economic tailwind in terms of higher prices being passed on into the future, right? How are companies broadly managing these higher costs from the war? And do you expect there to be revision in earnings? Today, we heard from Rio Tinto. However, it maintained its full-year production guidance across its operations, despite what it says is higher diesel prices. So it seems it, at least, is coping.
Yeah, it's just mixed, really. We've seen a lot of large companies globally come to the markets with updates, whether it's Pirelli, the tire company. They've come out and passed on price increases. You've had the big fashion brand Hermes come to the market and update the market with some flagging sales, primarily due to lack of traffic in airports. They suggested Costco, Pepsi, these kind of businesses have all been pretty active in getting the news out into the market as to the impacts on their businesses. But companies will adjust depending on their industry and depending on their market position. Some will pass costs through selectively. Others will, sit tight for now, look to absorb the costs and maybe incur some hits to margins with the hope that this is more transitory than a long-term impact. But there's no doubt that the longer that this persists, the impact on corporations will be significant and they won't be able to massage things around the edges to try and delay and play for time. But we've already seen, some instances with the likes of Pepsi of shrinkflation, optimizing the product mix. So these kind of tricks the companies can play, which keeps their head above water in the short term. But over the long term, if we continue to see this prolonged conflict, then it's very difficult to hide.
In the meantime, though, inflation expectations are rising. The ANZ Roy Morgan Weekly Inflation Expectations Index had its third highest result in the history of its research. What's the market then thinking this will all mean for interest rates and perhaps the Australian dollar, given we're seeing the US weakening?
Yeah, it's very interesting at the moment because obviously on one hand you've got rising oil prices, which is very inflationary, and there's no doubt that Australia over the next couple of quarters at least will enter a stagflationary period, a period where you have rising inflation and slowing growth. But on the other hand, you've got a situation where higher oil prices and higher petrol prices are in effect a rate rise for consumers. So at some point, that will curb the demand side of inflation, which is a big driver of it. And obviously, then you've got the supply shock. But where that all lands remains to be seen. There's a very good chance that the RBA, I think it's almost priced in, that the RBA will raise rates at their next meeting for the third straight time. And that'll reverse all the cuts that came through in 2025. The question is, from here, what happens? And unlike in the US, our economy is very, very tight at the moment, which means that the RBA is very, very reluctant to let things run too hard. In the US, they've got very weak consumer demand, and that's naturally putting a ceiling on things, whereas there's slightly different setup in Australia at the moment with really no spare capacity in the economy at all. So look, our view is probably that at some point you get a situation where the economy weakens to the point where you can't just keep raising rates into that environment because you'll curb demand too much. But you've definitely seen a divergence in the 10-year Treasury yield in Australia compared to the 10-year Treasury yield in the US. And the fact that our bond yields are significantly higher now than they are in the US puts upward pressure on the Aussie dollar. And that's obviously a symptom of the fact that our interest rate policy is at a very different juncture compared to the US.
And so with all that in mind, what are you telling your clients right now, and where do you see the opportunities for investors?
Yeah, I mean, at the moment, we're looking at a couple of parts of the market. We're trying to sort of identify those areas of the market that have been harshly treated in recent months, partly as a result of the Iranian conflict, but also potentially due to the big SaaS apocalypse that was playing out in the months before the Iran conflict overtook the headlines. And if we look back to sort of 2022 and then the recovery year in 2023, many of the sectors that got beaten up the most in that downturn were things like technology, consumer discretionary. They suffered before bouncing back very strongly. So we see some value in the technology space and the growth space more broadly. We feel as though small caps are almost the cheapest they've ever been relative to large caps on the Australian market. And by small caps, I don't mean tiny speculative micro cap businesses. These are companies that sit inside the ASX 300, but from the ASX 100 to the ASX 300. So there's some good value on offer in that part of the market, in our view, as well as the fact that we think the gold price is a pretty attractive space to be as well. That's obviously moderated a little bit, but it has historically done very well in the years preceding a conflict such as what we're seeing at the moment.
That's Michael Wayne there, Managing Director at Medallion Financial Group, and he wraps up the podcast for this Tuesday. Give it a like, a review, and subscribe if you enjoy it. And don't forget, you can watch On the Money during the 6:30 weekday edition of SBS World News on SBS. The podcast returns tomorrow. It drops after the market close every weekday, and I'll catch you then. This SBS On the Money podcast is provided for informational purposes only and should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.